Hey guys, welcome back. Today we're going to be discussing a big bet that Buffett made in late 2007. Just recently I've just completed listening to an audiobook called The Random Walk Down Wall Street by Burton G. Mackell. This is the 12th edition, so it's the latest 2008 edition, I think was from memory. Fantastic book, I highly recommend it. But one of the core sort of subjects from this particular book was the advantage of just investing into low-cost index balance funds that track the entire market wherever that may be. This book is more based for US investors, but a lot of the core subjects and investing strategies can be brought over to Australia and New Zealand as well. And you can either invest in the US through low-cost index balance funds there, or in the equivalent markets we have here in Australia and New Zealand as well. So that was one of the sort of core takeaways from the book that I found. And one thing they did mention in the book, which was around this bet that Buffett made in late 2007 with the hedge fund industry. Okay, he stumped up and he said about the end of, I think it was December 19th, 2007 from memory. He made a bet to the hedge fund industry as a whole. If anyone's keen to take him on, he was keen to put down $1 million bet that he could beat any hedge fund with just a low-cost index balance fund of his choice, and see if with any hedge fund would be keen to take him up on that bet. There was a company that did take him up on that bet, was called Protégé Partners. So that's something we're going to be digging into today, having a look over the 2017 Berkshire Hathaway letter, where he goes into detail. Some of these numbers are all around this particular bet. It's super interesting. Hope you guys enjoy the video. If you do enjoy the video, guys, it'd be much appreciated if you hit that like button. Helps me out a ton. And if you want to see some future videos like this moving forward, make sure you hit that subscribe button so you're the first to know when the next video drops. With that said, let's jump into today's video. Guys, I'm over on BerkshireHathaway.com. This is a fantastic resource if you're a bit lazy on a Sunday morning or something and you want something to read. I highly recommend you jump in and read over some of the Warren Buffett's annual reports. Don't let the website fool you. It's a very basic, old school looking website, but there is an absolute wealth of knowledge to be had on here. Today in particular, we're going to be looking at the 2017 annual report. I haven't read over all these reports. It's something I've been meaning to do, but it just sort of keeps getting pushed back and back. I have read over a number of them, but I have not read through all of them yet, but it's something I would like to do. If I could get an audiobook of all the annual reports, I would just love to listen to that, but as it stands, I'm slowly reading my way through them. Anyway, like I said, today we're going to be looking at the 2017 annual shareholder letter, and we're going to be looking at this particular bet that Warren Buffett made in 2007. So let's jump in and have a look at it. In the end, we're actually going to have a look at the actual index fund that Warren Buffett looked at and put this bet alongside. So make sure you stick around for that one. So here we have on page 26 of the 148 pages of the letter, where he's talking about this particular bet. I'm going to leave a link to everything in the description below if you guys want to jump through this and have a read of it, which I highly recommend as well. Warren Buffett has an uncanny way of, breaking down some quite complex financial terms and making it easy to understand for everyone, I feel.
Most people go through life using up a very, very small part of their potential. And so anything you do that invests in yourself, that's the best investment you can possibly make. And then I would follow my passion. I mean, whatever turns you on. I was lucky. I found something early that turned me on.
To my bet in history, in Berkshire's 2005 annual report, I argued that active investment management by professionals in our group would, over a period of years, underperform the returns achieved by rank amateurs who simply sat still. So what he's meaning here is he thinks if you were just to invest into a low-cost index balance fund, that would outperform any of these active managers that are buying and selling on a daily basis and talking to CEOs and going to managers' meetings and all sorts of different things. He thinks if you just sat on your hands at absolutely nothing for 10 years, this would beat him. And like I said, we're going to look at the particular fund that he invested in at the end, so make sure you stick around for that. So as we're just going to scroll through a couple of key things here, then we're going to actually look at another article on Investopedia as well, which goes over some of the key fundamentals from this bet. So subsequently, I publicly offered a wager of $500,000. So the bet was he was to put up $500,000, and anyone that was keen to take on the bet would put up $500,000, and both that money would be pooled, and at the end of the 10-year period would go to the chosen charity of choice. So he was saying the pro could select a set of at least 5 hedge funds, wildly popular and high fee investing vehicles that would over an extended period match the performance of unmanaged S&P 500 index funds charging only token fees. So minimal fees is and then I suggested a 10-year bet and he named the low cost index Vanguard S&P fund, which tracks the S&P 500. So everyone knew who they were betting against. It wasn't like they were betting against Warren Buffett. I don't think anyone would come to the party if that was the case. And so then he was expecting, thousands of managers to come forward and want to step up to the plate for this one. So here he says here, so After all, these managers urge others to put billions on their abilities. Why should they fear putting a little of their own money on the line? What followed was the sound of silence. So absolute crickets. No one was keen to stump up to the plate. Though there are thousands of professional investment managers who have amassed staggering fortunes by touting their stock-selling prowess, only one man, Ted Sade, stepped up to the challenge. Ted was a co-manager of Protégé Partners, an asset manager that had raised money from limited partners to and from funds of funds. In other words, a fund that invests in multiple hedge funds. I think there was about 200 different hedge funds within these different hedge funds. They don't actually go on to disclose the 5 particular hedge funds that he was betting against, because I think there's a lot of those hedge funds would lose a lot of customers and business if they were publicly disclosed. The only one that was publicly disclosed was the particular fund that Warren Buffett himself invested in. So we're just going to scroll down here and have a quick look at the results. So there was 5 different funds from 2008 to 2016 when the period finished. So here we can have the 5 funds below. So over that whole period, 8.7% for Fund A. Funds B was 28.3%. This is how much the fund returned over that time space, over the 10-year period. So Fund C didn't do too bad, coming in at 62.8%. Fund D coming at 2.9%. That's shocking. Funds E coming at 7.5%, and then the S&P Index Fund, which Warren Buffett's bet was, coming at 85.4%. So that was the key sort of things there. Let's just jump in and have a look at this little article over on Investopedia. Like I said, I'll leave a link to this in the description below so you guys can dig through this if you wanted to read over it a bit more. So like I said earlier, each person like Buffett and whoever was keen to take it on was put up the $500,000 each. So here it was, but actually it wasn't $500,000. It was, the sides initially put in 60-40 split evenly, and they were just going to put that into T-bonds. So this is one little sort of side note to the bet as well, which is I find quite interesting. And over the space of the 10 years, that would mature to the $1 million mark, which then they could in turn put on to the particular charity that they both chose. But the financial crisis saw interest rates plunge and set the bonds up to nearly $1 million in 2012. By mutual agreement, the bettors sold their bonds and bought actively managed Berkshire B shares, which were worth $1.4 million as of mid-February 2015. So that was a 119% return, blew both the Vanguard fund and Protégé funds out of the water. The stock returned an additional 19.1% from the end of February 2015 to September 8, 2017. If the share price had dropped, the winning charity was guaranteed at least that $1 million mark, which I think even Buffett said if it drops back below somehow in that period, he'll just make up the difference sort of thing, which I think was a pretty safe bet for old Buffett there as well. So the money actually, so obviously Buffett took out this competition and then he invested it to the $1 million will go to the Girls Incorporated of Omaha. I'm not too familiar with that particular charity, to be honest. But let's jump in and have a quick look at the particular fund that Warren Buffett bet against. So this is it here. It's a Vanguard fund. The Vanguard 500 Index Fund, Admiral shares VFIAX is the ticker code. And it is, we're just going to look at the quick numbers around this particular fund. So it tracks the top 500 companies on the US market. And look at the management fee here, guys. It's 0.04%. So minimal management fees, which is something I always look for, especially if I'm looking at any ETFs or index balance funds. I'll always look at the management fees, see what they are, and then we'll look at see how the returns have been. And I generally, Vanguard are some of the best, lowest fees across the board. So this was the particular fund that he was looking at here. Let's just scroll down and have a quick more of another look through it here. So let's say you would invest in 2011, you put $10,000 in. By the end of 2021, you would have 35 grand. This is looking in the past. Anything future is not guaranteed, obviously. And this is the last sort of 10 years. Since inception, they've only been getting around the just over 7% here. But the last year, they've had quite a good year by the looks of things, with a lot of the stocks that are in this fund as well. Let's just make a quick look at the top 10 holdings of this particular fund. This is the breakdown here of the percentages across all different sectors. Also the number of stocks. So currently at 509, fund net total assets of 658.3 billion. Net assets of 10 largest holdings coming in at 28%. And these are the top 10 holdings within the fund. So we've got Apple, Microsoft, Amazon, Alphabet, Facebook, Tesla for all you Tesla fangirls out there, Berkshire, JP Morgan Chase, Johnson & Johnson, and Visa. Pretty sort of lineup of companies there. So that makes up 28% of the fund there. So there we have it, guys. What are your thoughts around this particular bet? I think it's pretty cool. It just goes to show the power of, you know, investing in just a low-cost index balance fund and how that should make up sort of the core of most people's portfolios. Hey guys, hope you got some value there going over the bet that Buffett made back in 2007. Just goes to show the importance of, you know, investing into these low-cost index balance funds and how they trump, you know, these big hedge fund managers that are actively trading on a daily basis and watching the charts and talking to managers and, you know, really sort of being involved with it all. Whereas Buffett pretty much sat on his hands for 10 years rather than the transition there from the bond to his own particular Berkshire Hathaway company. That he did no work essentially for that, and he trumped them. So it just goes to show, you know, that the power of investing into these hedge funds, and it should make up a sort of core part of most people's portfolios, I feel, as well. And that's one of the key sort of things that I took away from this particular book as well. So I highly recommend the book, like I said, and they mention this in the book as well. That's why I thought I'd make a quick video on it. Like I said earlier, guys, if you got some value from this video, it'd be much appreciated if you hit that like button, and if you want to see some more videos like this moving forward, make sure you hit that subscribe button. With that said, guys, I hope you enjoy the rest of your day, and we'll catch you in the next video. Cheers, guys.